Accounting, a simple, concise, and complete guide to the basics of accounting. Accounting for sole proprietorships, LLCs, Business Quick Start, QuickBooks. Written by Leonardo Gorman. Narrated by Mindy Newell. Introduction. Congratulations on downloading your personal copy of Accounting, a simple, concise, and complete guide to the basics of accounting. Thank you for doing so. The following chapters will discuss some of the many different skills you will need to be able to work in accounting. You will discover how significant paying attention to exact numbers and tax documents is. The final chapter will explore ways that you can get started toward a career in accounting and be able to own your own business. Accounting can be tricky, but you will be able to make sure that you are getting the most out of your business when you learn how to do your accounting. There is a lot more to accounting than these basic principles, but this should at least give you an idea of what you can expect when you are working on your business. Follow these basics to learn the bare minimum of accounting. You won't be a CPA after you read the book, but you will certainly have a better grasp on accounting and the information that is included with it. If you have any questions about the terms that are included in this book, be sure to read the last chapter, the glossary. It will give you a simple and straightforward definition of each term in the book. There are plenty of books on the subject on the market. Thanks again for choosing this one. Every effort was made to ensure it is full of as much useful information as possible. Please enjoy. Chapter 1. 10 Things You Need to Know About Bookkeeping. The first step is usually the hardest, and you have taken that first step by making a choice to start your business in accounting. It is a good idea to make sure that you know the basics before you get started. While it may be necessary to learn more as you get more into the accounting world, these 10 should give you an idea of what it is like to work in the accounting field. Number 1. AP stands for Accounts Payable to You and Your Company. This is everything that you need to pay out, like the money that you pay for your building, your electric, and even the supplies that you need to make your product. In short, this is your business expenses. Number 2. AR stands for Accounts Receivable. This is a type of account that you need to be able to understand if you are going to do anything with accounting. Accounts receivable is when there is something that has been purchased but not paid for yet. It usually happens in a business setting. In short, it is your profit. Number 3. Cash. Cash is just the idea of primary money. Since no electronic record goes along with money as it does with credit cards or checks, you should make sure that you keep track of all of the cash using a ledger. Number 4. Equity. This is the amount of money that an owner or owners have invested into the business. The more people who are owners or holders of the company, the more complicated the equity that they hold is. Number 5. Inventory. The things that you have sitting and waiting to go out to customers is inventory. When you have that sitting, it is the same as having the cash value of it, and it allows you to make sure that you have a high valuation of the business. Number 6. Loans payable. Most business owners have some loan that they have taken out. While this can be included in with the AP, most keep it separate to keep better track of the loan or loans that you have. Number 7. Payroll expenses. Any business that has employees or pays the owner of the company will need to deal with payroll costs. This can eat up a huge chunk of profit, so many business owners tend to try to keep these as low as possible. Things that are included with payroll expenses are salaries, benefit payments, and workers' compensation insurance. Number 8. Purchases. This is similar to AP, but it is different in that it is only used for things that you buy for the business. More specifically, it is supplied for making your products, supplies for running the business, and things that you need to keep your business going. Number 9. Retained earnings. If you have ever heard of someone putting their profits back into their business, this is what it is. The retained earnings are the amount of money that you put back into your business, and they usually come out of the profits. This does not include the money the owners have paid to themselves. Number 10. Sales. This is the amount of money that you have in sales and the money that you make from the sales that you have done. If you can keep track of this, it will be much easier to see the profits that you have. Chapter 2. Profits and Losses. The profit and loss statement, or more commonly referred to as the PL statement, is what the company looks like on the books. It is a look at the business over a specific period, from a month to a quarter to a year or even longer. The longer the amount of time that is included on the PL statement, the better chance at understanding the accuracy of the business valuation is. There are many different ways to take a look at profits and losses, but electronic forms are the most common ways for business owners to keep track of the PL of their business because they are easy to use, can be stored with the accountant quickly, and are usually free for the business owner to download when he or she is trying to get started with the accounting aspect of the business. Many people do not start a business because they think that they are going to become filthy rich for it. And they certainly don't start one because they want to have more bills piling up. Some people don't even understand that there will be profits and losses in the business and only start doing their business because they have something that they believe in and are passionate about. Creating a PL statement is as simple as figuring out the profit of your business. Find what the total sales are for the business, what the costs are for the business, and figure out the difference in the two. $10,000 sales minus $8,000 costs equals $2,000 profit. This is a good business model, but is something that most businesses won't necessarily see right away. Many businesses lose sales in the beginning, and that means that the PL statement will probably look more like this. $10,000 sales minus $12,000 costs equals negative $2,000 or a loss. Seeing this can be daunting, but business owners should not be alarmed. It is normal and expected for their business to underperform in the beginning. There are many more costs that are associated with starting up a business than there are with simply running one. If, after a year, the PL statement doesn't begin to show more profits than losses, it can be concluded that the business will probably not be able to survive, or there needs to be something done to decrease the expenses or increase the sales. Within the first 3 quarters of your business, you should begin to see at least a small increase in the profit that comes directly from the business. There are different ways that businesses may want to break up the PL statement. A sale is a sale, and the profits that come from it will always be the same. But there can be vast differences in the costs of the business. For example, a business owner may want to separate the costs for creating the product from the costs of operating the business in the building. This can mean that the PL statement will look scattered, and you must take the time to figure out what is the profit or the loss according to the sales and the expenses. Here is an example of how costs may be broken down. $10,000 sales, $2,000 payroll, $1,000 operating, $3,000 materials, $50 petty cash, $1,000 loan payment. The sales are, obviously, the amount of money that the business made in the period that the statement is for. You can put that over on the sales side of the equation. Then you will need to put the rest of the expenses on the costs side of the equation. Then it will look like this: $10,000 minus $2,000 minus $1,000 minus $3,000 minus $50 minus $1,000 equals $2,950. The profit would be the sales minus all of the costs that are associated with the business. This is as basic as the PL statement will look, and there is a good chance that you will never see something as simple as this when you are looking at the taxes of an actual business. There is also a chance that the profit margin will never be that high for a business, especially one that is just getting started. With a real business, you will need to figure out the different costs of the business about the total sales of the business. There will be things that you need to learn, like the total cost of advertising and marketing, along with insurance, overhead costs, and even costs that are set aside for incidentals. Looking out for each of these things when you are creating a PL statement or just simply reading one will make it easier for you to create a statement that is as true and accurate as possible. As you are creating the profit and loss statement, be sure that you use all of the ledgers and you double-check the work that is in them. If something looks like it is out of place, be sure to check with the person who wrote in the ledger. It can be something as simple as a mistake as someone adding an extra zero to a statement. Chapter 3. The Balance Sheet. Making one work for business. While the profit and loss statement is a great tool to use to get a short-term idea of what is going on with the company, the balance sheet is what you will need to use if you want to make sure that you are getting the most out of the different aspects of the business. There are several different options when it comes to a balance sheet, but one of the biggest things that you will be using the balance sheets for is to figure out the financial standpoint of the company. You need to make sure that the balance sheet is accurate and it includes all of the assets of the company, including the equity the owner has put into the business. The balance sheet should always include the net worth of the owner of the company, which will help to contribute to the total value of the business. An owner who is worth a lot can increase the value of the company. A balance sheet is something as simple as using a spreadsheet. You can create your own using programs like Microsoft Excel, or you can even create an account with QuickBooks. While the latter of the two will cost you some money, the former will be a great option for you. You can find out a lot of information just from the templates that are included on Excel, and you can make sure that you are working to put all of the information into the sheet. To create a balance sheet, you must first understand how they work. Your balance sheet will have two main components to it. The assets and the obligations need to balance out when you create the sheet. That is the point of the balance sheet, and it will show you what you need to do to make sure that things are all figured out. When you can balance the information, you are going to have an accurate look at what the business is like and what you can do with the business. There are many different aspects that go into the balance sheet, but the majority of them revolve around trying to make the assets higher than the obligations. The assets that are included with your business will be a combination of each of the following. Current, AR, cash, inventory. The current assets are things that will only be active in the business for around 1 fiscal year. They change from time to time and may be different depending on the time of year that you are looking at them. For example, a pool supply company may have more assets in inventory during the winter months, but it will have more assets in cash during the summer months. Cash is the best thing to have as a current asset. If there is anything in your business that you want to be able to increase the value with, you should try your best to make sure that you can convert it to cash. Doing this will make your company more valuable because the asset will be higher if there is a lot of cash instead of there just being a lot of inventory that will equal cash when and if it sells. While inventory can contribute to your total value, it will be much easier to have cash as a contribution. Non-current, property, machinery, technology. Each of these things is going to contribute to the overall value of the business, but they are not as easy to convert to cash as inventory would be. If you are going to count these as the total value of the company as assets, which you should, you need to make sure that you are accounting for depreciation on each of the items so that you will not lose out on money because the items are not really worth what you thought they were, or what you paid for them when you purchased them. Depending on the area that you are in and the type of business that you own, the value of some of the non-current assets, like land, can go up when you own it. You should make sure that you keep track of it and that you can make sure that you are getting the most out of it. If you know the right way to account for depreciation or inflation on the land, your business will automatically be more valuable than if you did not take any of these things into account. Each of these will contribute to the value of the business, and they will be listed as assets on the balance sheet. You should put them on the left side of your balance sheet, or if you are using a template, anywhere that has a spot for the assets of the company. On the contrary, your liabilities are what you are financially responsible for. They can include each of these. Short term. The liabilities that you will need to pay within a year will be included in the short-term liabilities. These are smaller loans that may have a year or shorter of a payoff term, accounts receivable, and anything else that you would be able to pay off in a year's time. You may also include periodic payments of longer-term obligations in the short-term liabilities that you have. Long-term. The only things that will truly be on your long-term liabilities are things like big loans that will be due more than 1 year from the time that you got them. They may be lower interest, longer-term loans. They may be a mortgage or even a big loan that you had to take out for equipment. You should always list these things on the long-term liabilities. The general rule is that if you are going to need longer than a year to be able to pay it off, you will list it as long-term. Once you put all of this information into your spreadsheet or your balance sheet that you have created, you will need to make sure that you are balancing it out. At the bottom of the sheet or somewhere in the middle, you will have the valuation of the business. This is what will show you what the business is worth when you break down all of your assets and your liabilities. Chapter 4. The Business Cash Flow. The cash flow statement is important because it will show you the way that your cash is going, whether you are gaining money or losing money. It is also important that you work to make sure that you always have a cash flow statement available. There are many reasons you would need it: lenders, inspectors, the IRS, and simply for your information. When you are just getting started, or if you plan to have a very small business throughout your career, you can keep track of the cash flow on a monthly basis. If you want to be able to do it less and put more on it, or if your business is growing, you may find that it is easier for you to track it on a quarterly basis. Using a cash flow statement is important because you should always have a good grasp on the cash that is coming into your business and where it is going out of. This is something that you will need to be able to get the most out of your cash and to monitor where it is going. You may find that your cash isn't exactly staying where it needs to be when you take a look at the cash flow statement that you have set up. Your cash flow statement should have 3 main categories. Financing. You will use this section of the cash flow statement to show where the cash is going when it comes to the stocks and the bonds of the company. You will also use this if you are going to be repaying any dividends on behalf of the company. You may find that you do not necessarily need this portion of the cash flow statement when you are first getting started because you may not own any stocks and bonds, especially if the company is new or very small. Investing. The investment section will contain all of the information that you need to know about the money that you put back into the business. If you purchase things for the business, buy any equipment or property, it will go here. If you have made a long-term investment into something for the business, this is also the portion of the cash flow statement that will see this. This includes major purchases that cost the company a lot of money, as well as smaller purchases that may seem petty. Failing to include these will mess up the entire cash flow statement and will make things look bad for your business. You may find that you think you are missing the money if you don't include these purchases. Operating. Anything that you do that will require you to pay money to be able to operate the business will be included under this part of the cash flow statement. You should include things like the cost of utilities, maintenance on the building, and purchases that you make to keep the business running. The operating costs will vary and can be somewhat vague, so be sure to include anything that you know is required to be able to run your business. Supplemental. This is not necessarily something that you will need to include on your cash flow statement, but it can be helpful if you are trying to keep the best record possible. If you trade items for something else, or you move them around within your business, you will be able to put them in this section. Even though you are trading the items, you may need to put down the tax and interest that is paid on them. If there is none, you don't need to keep them on your cash flow statement. You should be keeping track of your cash as it comes in and goes out. This is something that will help you to make sure that you are always having a good idea of what it means to your business. Make sure that you can get the most out of your business by always writing down the information as soon as you get it when it comes to the cash that comes into and goes out of your business. If you do not know how to put it down or what category to put it in, simply put it in the supplemental section. While there are many things that you can do on your own when it comes to your taxes and your business, it may be easier for you to do your cash flow statement with a program or a type of software that you can use right on your computer that is associated with your business. This would mean that you would need to put some money into the program, but again, it is something you will be able to write off when it comes to paying taxes. It is a wise idea to use the software because understanding your cash flow can be complicated and you may not be able to get everything on there that you need to make sure that you are doing it the right way. The software can also be helpful in making the decision where something needs to go on the cash flow statement. If you think that it will be a better idea for you to just do it yourself, be sure that you have a template, at least, to work off of. Once you have finished the month or the quarter for which you were keeping track of the cash flow, you will need to review it. You should look to see where your money is going, what you can cut back on, and if there are any red flags. If you are not the one who is keeping track of the cash, who is? Look for a lot of supplemental charges on the cash flow or anything else that may be similar to it so that you can make sure that your cash is going where you think it is going. Chapter 5. A Look at Ratios. The ratio that you have for your business should all depend on what you have coming in and what you have going out. The ratio should always be more to the positive and should never gravitate toward the negative, except for in your first 2 quarters of business. If it happens to be a negative ratio at any point other than that, you need to take another look at it and figure out if there is a problem with the expenses that you have. If it lasts for more than 1 quarter after the first 2 quarters, you need to take action, and you might need to reduce the expenses that you have for your business. There are several different ratios that you should look at, including your profit ratios, which will be among the most important things for keeping track of the financial health of your business. Number 1. Daily sales. The chances are that you have a certain goal that you have created for your business. You should be working toward that goal on as small as a daily basis so you can see what you are doing with the business and if you are where you want to be. To figure out if you are in line with what you want to be, you should use a daily sales ratio. Number 2, debt to wealth. This is something that lenders and other business people are going to use when they look at your business and what you have put into the business. You should make sure that you are figuring out the right way to do your business by keeping your wealth as high as possible and keeping your debt as low as possible. Figure out how much you have in debt and then divide it by the amount of money that is in your net worth. This is what will allow you to get loans and be able to make purchases for your business on credit. Your debt should, obviously, be much lower than your wealth. Having a lot of debt will hinder your ability to run the business smoothly. Divide the daily sales goal by the actual daily sales to get the ratio that will show you if you are performing on a day-to-day basis. Say your goal for the day is $300 in sales and you have made $150 in one day. Divide the $300 by the $150. That is your day ratio, and that isn't a very good one. Your bottom number should be equal to or greater than your top number. Even businesses that don't necessarily do well with their finances and their expenses can have a good gross profit, which can be misleading when you are looking at your financial health. You should make sure that you don't use this as your only measurement of business wealth by keeping track of your profits in a different way. For example, if your gross profit was $3,000 and you had expenses of $2,200, then your net profit would only be $800. This is how it can be deceiving to use the gross profit. It may seem like you have made a lot of money when you look at your total sales. It will seem even less when you look at your gross profit, but the real truth comes from the net profit and what you made after you took all of your expenses into account. Number 3, gross profit. This is the total amount of profit that your business makes based on the sales that you have. It is figured out by learning the amount of money that you made and the amount of money that you spent on the product or service specifically. You need to know how much money you have made to be able to learn what the gross profit is. If you made $5,000, but you spent $2,000 to make that amount of money on the products, you only made the $3,000 on the product. That is what is known as the profit on it, and the gross profit is only the amount of money that is made on the product after the cost of the raw materials for the product is deducted from the total you made trying to get the product and selling the product to your customers. It is a good idea to try and make sure that you are getting the most out of your business and that you are figuring out how much gross profit you have in the business. Number 4, net profit. It is much better for you to use the net profit to figure out where your business is and where you would like it to be when it comes to the money that is going in and out of the business. Figure out your gross profit first, and then it will be much easier to figure out the net profit. It is a good idea to use this measurement when looking at the financial health of your business because it will allow you the chance to see how your business is performing and what type of financial situation you are in, because the expenses go into the net profit. Your net profit is your gross profit divided by the expenses that you have for the business, not including the expenses that you included for the raw materials. Chapter 6. Accounting for Tax Purposes. The only thing that is certain in life is death and taxes. A huge percentage of people who live in the world, and everyone who is in the United States, will need to pay taxes at some point in their life. The majority of people, though, don't know too much about taxes. Most know that they come out of a paycheck. They can be a burden, but in the cold winter months, they usually, hopefully, get some of that money back so that they will be able to enjoy the money that they overpaid to their government. This is the only information that employees need to know because their business takes care of the taxes. But what happens when the employee becomes the business and they must figure out how to pay those taxes and what it means to send them off to the government? Business. The type of business that you are working with or have on your own will make a difference in the type of taxes that you must pay to the government. Each business will have different aspects to it, and there are different laws concerning each business. Whether you own an LLC, a corporation, or even a partnership, you need to make sure that you know the laws of it. Since there are so many different types of business and hundreds of tax laws that go along with each of the different types of business, it is a good idea just to learn the information about the business that you own. Deductions. Any legitimate cost that goes into the business can be written off as a deduction. You can use the client comfort costs you have, the internet, health insurance for employees, interest on loans, vehicle mileage, gas, technology, retirement plans, business travel expenses, and any small supplies that you may purchase for your business. These are all things that you can write off, and it will allow you the chance to make sure that you are getting the most out of it. This can also drastically reduce the amount of money that you have to pay taxes so that you can get more out of the tax process and so that you can make sure that your taxes are taken care of. Instead of having to pay a huge lump sum at the end of the year, work to make sure that you are paying taxes each quarter. You don't need an accountant to do that. You just need to figure out how much you will owe for each quarter and set it back so that it's waiting for you at the end of the year. This, again, will keep you from scrambling to have to get a lot of money at one time and risk owing to the IRS, which has the potential to shut down your business. Payroll taxes. Any business that has one or more employees will need to pay the taxes on those employees. You should deduct around 20 to 25% of the total amount that the employee is getting paid for the taxes that will be included with the payroll. When you hire the employee, you need to use the tax forms to figure out exactly how much to deduct and what you need to do to make sure that the taxes are being paid. You can consider asking your employees for the information that you need to put their taxes into their payroll information, and to ensure that you are taking the correct amount each time that they get paid. Tax estimates. When you get paid by a client, you will need to set aside from the money. This is just an estimate of what you are going to need to pay in taxes later on, and it can mean a difference in whether you are comfortable with the tax situation you are in, or whether you are scrambling to get caught up at the end of the year when you need to make sure that your taxes are being paid. If you take out some of the money from the sales that you bring in, you will be set at the end of the year when you need to make a larger payment to the IRS. It is a good idea to put the money into an account that accrues interest. This way, you will be sure to have enough money, and if you end up having more than what you need, it will be extra that can go right back into the business. Your tax. As a business owner, you will need to pay taxes into Social Security and Medicare. This is normally taken care of by the business, but since you are, essentially, the business, you will need to make sure that you are paying it on a yearly basis. Begin setting aside about 15% of everything that you make to contribute to this. Start by putting it into an interest account. High interest is always best. And make sure that you are doing it each time that you pay yourself. You have to pay it on a yearly, not quarterly basis, so doing this will allow you the chance to make sure that it is being paid on time and that you are going to be able to pay it. If you don't, there are big penalties that come from it. Chapter 7. Keeping a budget for your business. Budgets are so important that they aren't just for broke families who are trying to save a few dollars with coupons. They are necessary for anyone who wants to make sure that they have enough money to operate their business and who wants to be able to get the most out of the money that they are making. It is a good idea to create a budget for your business so that you can reduce the risk of your business failing. You can have a clear idea of where your money is going, and you can know at all times how much money you have to spend on incidentals. Creating a budget for your business is similar to creating a budget for your home, but it is much more complicated than that. You won't just be looking at the money that comes in and goes out, but you will be looking at the way that the market changes, the problems that could come from your business, and the things that you need to do to make sure that you are getting the most out of your business. There are a few important steps that you must take to truly budget for your business. Use a spreadsheet. You should probably just go ahead and invest in the Microsoft Business Program or something similar that will give you Excel before you even get started with your business. You are going to need a lot of spreadsheets to run the business, and this is just one that will show you what you need to do. Get this ready before you even open your business and keep track of the information that you are going to use for your budget in the future. It will allow you the chance to make sure that you are staying on track with the budget. Keep the spreadsheet with your other important business documents and somewhere that you can easily look at it to know what you want to spend. Review your budget. Your budget is going to vary from year to year, and even quarter to quarter. As your business grows, it might even vary from month to month, which can make it hard for you to be able to keep up with it. You should make sure that you are doing everything that you can to keep your business budget on track and up to date with all of the money that you are putting into the business and taking out of it. Review the budget on a regular basis so that you can make changes where they need to be made. Look at other businesses. This is one of the only ways that having some competition is going to be able to help you when it comes to your business. You should use the competition and some of the other businesses in your area that is similar to yours. Try to find out what they are paying in taxes and what their relationship with the IRS looks like. If you want to make sure that you are learning as much as possible about the tax situations that they are in, you can look at past tax records and information on the business that will show you how much money they paid to the IRS in years past. You can set yourself up for success by using that as a base point for your business. Set aside some of the money that you make that would be able to cover that percentage. Even if it is slightly higher than what you would typically expect to pay the taxes that you are going to have for your business, it will help you to have enough money to not worry about the taxes. Give yourself a break. When you are first starting your business, you don't want to be on a super tight budget. Give yourself a little break when it comes to your expenses. Choose to write them into the budget slightly high so that you don't have to worry about what you are going to add to it, or even consider putting some wiggle room into the budget so that you can make sure that you aren't spending too much money on your business. If you give yourself a little slack when it comes to the business, you will be sure to always be slightly more comfortable than if you had a budget that was tight. Cut when necessary. There is a chance that you will need to cut costs for your business. This could mean cutting back the hours of employees and doing more work yourself, or skimming off some of the extras that you have in your business. You can even consider trying to reduce the quality of your products, but then you might lose customers who can notice the difference in a brand name ingredient and one that comes from a generic source. No matter what you are doing to make sure that your business is going to be able to work with the budget, you need to make sure that you are prepared to cut costs. The chances are that you will need to cut the costs of your business at some point, so make sure that it is something that you will want to be able to do and something that you are comfortable with doing. Check regularly. When you are first getting started, it may be tempting to choose the first supplier or the service that you find. You may want to do this so that you can get the most opportunity out of it, or because you just want to get your business off the ground. But this isn't the best idea for your business. Shop around and try to find a different supplier that will offer the same service, but for a lower price. The quality should stay about the same, but it should be something that you are comfortable with. Just make sure that you are not sacrificing anything. You don't have to reserve this practice to just when you first start your business, though. Always have your eye out for cheaper suppliers and services that you can benefit from, so that you can make sure that you are getting the best price possible. Chapter 8. Don't slack on accounting skills. This book is not intended to make you a CPA or even someone who could go out and get a job at an accounting firm right away. It is meant only to allow you to understand the way that your taxes work with your business and the way that money can have an effect on your business. You should understand the way that the money that comes into your business works and the way that you can make it work for you. These tips will help you to stay on track when it comes to your accounting and will give you a good start to your accounting business. It is important that you follow these tips and always try your best to make sure that you are doing accounting the right way. If you don't, you may find that you need to hire a professional to do your accounting, which is what you were trying to avoid, right? Track the expenses. Did you buy a pack of pens at the 99-cent store to use for your business? What about a ream of paper because it was on sale and you needed some for the printer? No matter what business expenses you have, you need to make sure that you keep track of them. You can do this by creating another spreadsheet or by simply keeping track of them with a handwritten ledger. Another thing that you need to make sure of when you are keeping track of expenses is that you save all of your receipts. Some people choose to just save their receipts and put the expenses down when they have a certain number of receipts, but this can get overwhelming, so just make sure that you write them down as they come in to avoid any problems in the future. Record money. When you are making deposits of cash or checks into your bank from the sales that you have made, you should record them right away. This will allow you to see how much money you have in the bank and the way that the money can work for you. If you don't write it down, you can get a printout from the bank of all the information that you have in your bank. It will show when you made deposits and how much money you made them for. Prepare yourself. You don't want to be caught in an emergency or have something tragic happen that you need to take a loan out to be able to handle. You can prepare for the unexpected by putting money away on a regular basis. This is like a business savings account and will give you a chance to build up the money that you need to get what you have to if something bad happens to your business. Try to find a high-interest savings account so that you can make as much money as possible from it, even when you are just putting it back in the bank. Personal and business stay separate. Even if you are running your business all on your own and you are trying to avoid taking a salary for the business, you should be sure to keep your business and your personal life separate. This is true not only in every other aspect, but also when it comes to your finances. You need to make sure that you are keeping your finances separate so that you can make sure that your business is operating as best as it possibly can. When you make the decision to run a business, you should be making a decision that will allow you the chance to keep things apart from your normal everyday life. Always purchase things and do expenses for the business separate from your personal purchases so that you can write them off. Payroll. Since payroll is probably going to be the biggest expense that you have for your business, you need to make sure that you are keeping track of it all of the time. This means that you need to see where your money is going on payroll and whether or not it needs to be harnessed back in. One thing that will nearly always kill your payroll budget is overtime, so try to have your employees avoid going into overtime as much as possible. Make a bill time. Each week you should set aside a block of a few hours where you do nothing but look at the books that you have and try to figure out what is going on with them. Balance your checkbook. Look at your reports and see if you are on track with the budget that you have made for yourself. If you can do this on a regular basis, it will make it less overwhelming at the end of the month, quarter, or year when you absolutely must look at each of these things. Hiring out. This may not be a great tip when you are first getting started and trying to save money, but it sometimes pays to hire out for the jobs that you are doing yourself. If you are growing your business, you need to make sure that you are doing everything that you can without getting too overwhelmed. You may need to hire out to contractors or even consider getting an assistant who will be able to help you with the various jobs that you have when it comes to your business. Having to pay a little more money when it comes to the things that you do may be worth it to help keep yourself from getting too overwhelmed. Follow up. If you have paid something, are waiting on something, or are trying to make the right decision when it comes to something in your business, you need to make sure that you are following up with all of the things. This means that you need always to check that you got paid or that you paid a bill that was required of you. Not following up could cause you to lose money from the customers that you have, but it could also cause you to have to pay major fines or fees later on if you didn't make the payment. Chapter 9. Local and State Taxes on Sales. While similar in name, sales taxes and taxes for business purpose are two completely different things. It is important that you make sure that you are paying both of them if you are running a business so that you can be within the parameters of the tax laws for the area that you are in. It is also important that you learn the exact information that you need to know when you are trying to sell goods. Each state has different rules and regulations on taxes. Some states, only a few, don't have any taxes at all. If you are in Hawaii, Alaska, Delaware, Montana, Oregon, or New Hampshire, you really won't have to worry about sales tax when you are looking at the different things that are associated with your business. If you are in any state but those, learn the sales tax rate and make sure that anyone who is doing transactions within your business also knows the rates and what they are supposed to be so that they can charge your customers for the sales tax. One of the most important things that you can do when you are collecting sales tax is keep a record of how much you have collected. Whether you do that with a program that is connected to your POS or you keep a handwritten ledger will depend on the way that you keep records for your business. It is always a good idea to have a rough hard copy of the taxes that you have collected, in case something goes wrong with the computer program that you normally use. The records that you have are very important, so treat them as such. The easiest way to make sure that you are doing sales tax right is to apply it to each of the purchases that your customers make. They are responsible for this tax, and you should apply it separately when you are checking the customer out. You can usually set up POS software to add the tax on at the end of the transaction, which makes it much simpler for you to be able to add the sales tax on. For example, if your tax rate is 8% in your state, you should add 8% of the sale onto the sale and then charge the customer for the total amount of the sale. If you are doing online sales, be sure to check your state laws on tax on shipping. Some states require you to put the tax on the sale before you add shipping, while some states require you to put the tax on the sale after you have already added shipping. Since sales taxes are usually a much smaller amount of money than federal taxes, keep track of them on a smaller level. When you collect the sales tax on an item, immediately put that amount back so that you can pay it. Unlike some of the other federal tax options that are available, you can usually pay the sales tax to your state or municipality on a quarterly basis. Check with your local laws because some states even allow you to pay it on a monthly basis. So that is one less thing that you will need to worry about at the end of the year or even at the end of the quarter. The thing about online sales is always confusing when it comes to taxes. You must charge customers sales tax on online items. If you have a business that is located in Maryland, but your customer is located in New York, you will need to charge them the tax where the business is at. So instead of charging them the New York rate, you will need to charge them the rate for Maryland. While you and your profits that come from your business are directly responsible for the taxes that you pay, the state tax or local tax is something that the consumers are required to pay. This is because taxes on the profit are the responsibility of the business. Taxes on sales are the responsibility of the customers. You are just responsible for collecting the taxes from the customer and remitting them to the IRS so that the government gets their portion of the money. You are also creating somewhat of a convenience for the customers because you are handling the process of giving the government their taxes, which is something that the customers would need to do without your help, and if you did not operate the business to be able to give the taxes to the IRS. Sales tax is one of the most confusing parts of taxes. The process for collecting it and getting it to the IRS is complicated and can be difficult for any business owner to understand. The only thing that you need to know about the process is the amount of tax that you need to collect and the way that you are required to submit it to the IRS. This is what you will be responsible for doing in your business. You also need to make sure that you are charging tax for online orders because that is a part of sales tax that has recently come under fire. Businesses were not charging taxes on online orders when they needed to be. To learn all of the tax laws that concern sales taxes in states, counties, and even individual municipalities would be nearly impossible. There are thousands of different tax laws around the country depending on the one that you are in. Towns can even have their tax laws that are separate from the state that they are in, so it is important to know that you will not be able to get all of the tax information that you need to learn about every sales tax law in the country. Chapter 10. The Shareholder Equity. Sometimes this is called the stockholder's equity. It is something that will be part of the way that you do things with your business, and it accounts for a large portion of the book value of the company. It is a claim that the owner has on the company, and it is the source of the money that you will be able to get from the company. There are many different parts to the shareholder equity, and the part that you use depends on the different things that you may want to do with the company. It is a good idea to look at every aspect of the company when you are doing the stockholder equity. The different parts of the shareholder equity include accumulated comp income, the loss that you have not chosen to include in the net income that was put onto the statement of the total amount that the corporation pulled in. Paid in the capital, the amount of money that was received by the company when there were stock shares issued. Retained earnings, the amount of money the corporation made less the amount of dividends that were declared by the company. Treasury stock options. This happens when a company chooses to continuously purchase the stock that they have and keep doing it instead of retiring it. When you own a company, you will have some say as the shareholder. This can be any amount of money that you put into the business, but does not include the amount of money that you have paid to be able to run the business. It is important that you work to make sure that you are getting the largest benefit from your own company by investing in it. An investment in the company will also help you to push forward with making sure that things are running right with the company. This means that because you have money invested in the stock of the company, you will be more likely to make it run better because you will get paid each time that the company goes up in value. Not only will you be paid as the owner, but as a stockholder. You will also have the option of being paid for the company that you are running. It is a good idea to try to become at least a minority stockholder in your own company. This will allow you the chance to make sure that you can make money from the company even if you are not paying yourself a salary. By investing in the company, you will give yourself a chance to not only expand your portfolio, but to have another stream of income that is coming directly from the company that you have built. Just be sure that you are going to be able to get the best investment possible by getting a good deal on the stocks that you buy into. Once you have become a stockholder, this is something that you will need to put on your income sheets. The amount of money that you have in the business should not matter, but it will make a difference according to the different things that you may do while you are running the business. You should take into account all of the money that you have put into the stocks of the business and include that on any sheets. While this can technically be considered a personal expense, it is something that will be part of your business and can cost you money that is close to the business. Another option that you have for your business and to be able to write off as an expense is to offer stocks and shares to your employees if you have them. This is a way that you can not only increase the value, but also show your employees that they are important to you. If you give them a chance to invest in something by paying for it for them, or just giving them a discount on the stocks, they will be appreciative and they will then be able to say that they own a portion of the company that they work for. You will be creating twice the benefit. The employee morale will increase and your business will be more valuable. Similar to how you can put your own investment on your balance sheets and make sure that you can count them in different areas of the money that you have, you can also include the employee stocks in your balance sheets. It is a good idea to always make sure that you include them so that you will be able to count them as a type of income. Your business will see an increase in value just from doing that. If your business is not traded yet, none of this will apply to you, but it is a good idea to keep it in mind. Your business will eventually grow and you may make it a traded business. When that happens, you should be the majority stockholder of it, but you should also work to make sure that you are providing your employees with the chance to be holders in the company too. While it may be fine to disregard this chapter right now because you don't have to worry about trading at this point, it is always a good idea to keep this in mind. Remembering it when you begin to trade your company will give you the chance to be able to make the right decision on your business. One of the most important business decisions that you can make when you own business is to always prepare for the future and try to make your business the best that it can be long before you start out with the different possibilities of having a successful business. Chapter 11. Reduced Business Value. The idea behind depreciation, or the reduced value of something, is that there is a process of making sure that the costs of assets are distributed evenly throughout the time that the assets are active. There are many different things that go into depreciation, but you must understand that the idea behind it is that you will not owe as much money in taxes if the value of your business is reduced, and you will have less that you need to worry about when it comes to your business. You should make sure that you are always valuing your business by including the depreciation of it, so that you do not have to worry about the many problems that could come with having an overvalued business. The amount of time that you have been in business will determine the depreciation value that you use to make sure that your business is going to be valued at the correct amount. The following methods are the most common ones that you will use when you are depreciating your business. Straightlining. This is the easiest method that you can use to find the depreciation of your business. It is simple to do, and you can do it without any special equipment. The cost of the business less the residual value of the business divided by the useful life of the business. A great example of this would be a company that has been in business for 5 years with an expectancy of 15. The cost of the business was $1.3 million, but the residual value of the business is $5.2 million. This would be $3.9 million divided by 10 years. The depreciation would be $390,000 per year that the business is in business for the rest of the expectancy. This number will fluctuate as the business grows, the value increases, and the life expectancy of the business shrinks or grows. The depreciation of your business is something that is easy to figure out, and it will allow you the chance to make sure that you are getting the information that you need. There are many different options that are included with the depreciation value of the business, but using them will all involve knowing the amount the business is worth, how much money it costs to operate, and how long the business has been operating in relation to the amount of time that it is expected to continue operating successfully. Be sure that you choose a method that allows you to see the way that your business has depreciated and will give you the best value for the amount you are spending in taxes. Declining the balance. This method is not quite as straightforward, but it is not terribly hard to figure out to get to the value that you are going to be able to understand the depreciation. It involves the book value of the business as well as the cost of the business. If you figure that there is a value of $140,000 in equipment, and you see the declining use of the equipment, you can figure out that $140,000 multiplied by the 40% of the declining value divided by 3/4 of the lifespan of the equipment you have purchased for the business, you would get the value of $42,000. Each time that you do it, you would get a smaller depreciation of the equipment that you purchased for the business. The biggest difference in this and the actual value of the business is that the value of the business has the potential to increase over time, and there is no way that the value of the equipment would be able to increase because the amount that it would depreciate over the years. The positive side of this is that while you may have equipment that is not worth as much as it once was, you will not have to worry about paying the taxes on the higher value of it. While it is important to make sure that you are valuing your business in the right way, it is equally, if not more, important to make sure that you are valuing your equipment the right way. It is common for your equipment to depreciate, but you need to make sure that you are keeping track of that depreciation each time that you do different things with the business. As you are learning the right way to be able to figure out the depreciation, you will also learn that there is a much shorter than normal lifespan on a lot of the equipment that your business may use. Sum of year. The depreciation of something that is in your business is going to be the cost less the salvage value divided by the amount that you had left in the equipment. This means that you still need to figure out the life expectancy of the equipment and create a fraction that will show you what you need to figure out, how far you are into the life of it, and how much longer you have left with the equipment. Just because that is the expectancy of the equipment doesn't mean that you have to rely only on that. Your equipment can, and probably will, be able to operate longer than the life expectancy, but this is just the number that is used to be able to figure out the value of it and how it relates to the cost of the equipment. There are many different things that will come into play when you are figuring out the depreciation by using this way, but you need to always add up the years that you have had it. This will allow you to see where it is at in relation to the expectancy and what you can expect to get out of it in the coming years. If you make sure that you are adding up all of the years, you will have a chance to see that the equipment is going down in value instead of going up, which is what you should have been expecting while you had it. If you choose to use one of these methods, you need to make sure that you are doing it the right way and that you are keeping track of the way that you figured it out. There is a chance that you will need to explain how you got to the point you were at, and keeping track of the way that you figured out the depreciation will help you if you have to prove how you got to the point in your tax documentation. Chapter 12. The Accounting Glossary. There are a lot of terms that you will probably read about throughout the book. You need to make sure that you know what they mean and what that means for your business. If you work to make sure that you are doing everything that you can with the accounting information that you have, you should have no problem figuring out how to handle your own accounts. Using this easy glossary will give you the help that you need when it comes to accounting. Be sure to reference it anytime there is a term that you don't know about. Accounts payable. The money that your business owes to the people who have provided you with goods and services, also seen as AP. Accounts receivable. The money that your customers owe to you for services or products that you provided, also seen as AR. Balance sheet. The way that the assets, liabilities, and equity are all grouped together. It is a report on finances. Capital. The value of a financial asset can be cash or even products that are sitting on your shelves, inventory. Cash flow. The amount that goes into and out of your business. Cost of goods. The amount of money that you spend to be able to get your products to your customers. CPA. A tax professional who is certified by the government to be able to prepare taxes and give advice on taxes. This requires at least a bachelor's degree and extensive continued training that is mandated by the government. Current assets. Everything that you have in your business that will be able to be used up within a year's time. It can be anything from cash to inventory and accounts that you are waiting to be paid. Expenses. Anything that you have to spend to be able to give your customers products and to run your business. It can be anything from the amount of money that you spend to create products, to your mortgage, to something as small as pens for your office. Fixed assets. The same thing as current, but they are longer-term amounts. They are things that will be available long after 1 year, like property and equipment. Ledger. A record of all of the financial information of your business. You can either have manual ledgers that are written by hand, or ones that are on the computer, but they should all have a lot of different information on them when it comes to your finances. Owner's equity. The amount of money that you put into the business aside from what you have put into it for it to be able to operate. Essentially, the money that you have invested in the stocks of the company. Profit and loss. The amount of money that you have either gained or lost from the different business operations. For example, many businesses see a lot of losses in the beginning, but they do begin to profit as they grow their business.